What are some ways to increase co-creation between banks and their clients?
So when it comes to co-creation, there is a lot of really great ambition, but we're all time poor. And more so in the technology environment that we're in at the moment, we are focus and attention poor.
In my view, the most immediate co-creation opportunity sitting in front of us right now is actually ISO 20022.
Lloyds is a relationship bank. Clients are at the forefront of what we do. Relationships should be enhancing to all parties. So we look at the priorities. We have a common interest with our clients.
I'm Mahika Ravishankar, Deputy Editor at Trade Finance Global.
My name is James Lowry. I lead the Trade and Working Capital Products team and Transaction Banking Products at Lloyds.
I'm Lasmo Orlovska, Head of Payments and Cash Management Products within Lloyds Transaction Banking Division.
My name is Llewellyn Maluli, and I run the Data and Intelligence team for Transaction Banking Products at Lloyds.
Welcome to Trade Finance Talks, your go-to trade, treasury and payments podcast. Brought to you by Trade Finance Global.
Hello and welcome to Trade Finance Talks. I'm Mahika Ravishankar, Deputy Editor at Trade Finance Global. Today we're going to be talking about innovation within transaction banking, and particularly the benefit to clients. We discuss the value of embedded services and data, the ways in which clients' requests from transaction banks have changed, and whether innovation is the result of market pull or industry push. I'm joined today by three transaction banking experts from Lloyds, Lasma, James, and Llewellyn, to tell me about the future of payments, the future of trade, and the future of data, respectively. Thank you for coming in today. Nice to see you all.
Thank you for having us.
Thank you.
Please, can you all just introduce yourselves and tell me about your role within Lloyds? James, why don't we start with you?
Thanks, Mahika. My name is James Lowry. I lead the Trade and Working Capital Products team and Transaction Banking Products at Lloyds. We support customers with their trade finance needs domestically and globally, where physical supply chains involving goods and services require banking and finance solutions. Our product range includes short-term international trade, working capital, risk management, as well as longer-term structured trade, export and asset finance. We leverage our insights and experience to help clients successfully navigate markets, trade corridors, and business cycles.
Thanks, James. And Lasma?
I'm Lasmo Orlovska, Head of Payments and Cash Management Products within Lloyds Transaction Banking Division. I'm responsible for payments and liquidity products that we offer to large corporate and institutional clients. So businesses operating at significant scale, often across multiple currencies and jurisdictions. What drives how we think about product development is really quite straightforward. Clients don't experience payments separately from FX and separately again from trade and data. They experience a single flow of money and information moving through their business. So we don't design them separately either. Our focus is on building capabilities that support that, making those flows more visible, more predictable, and easier to manage.
Thanks a lot, Lasma. And Llewellyn, over to you.
My name is Llewellyn Maluli, and I run the Data and Intelligence team for Transaction Banking Products at Lloyds. So I'm responsible for how our products and our user journeys are built around data and how they use tangible insights to solve some of those strategic challenges for treasurers. And that's very much about starting from the treasurer's perspective, thinking about the strategic objectives that treasurers have, thinking about how we can combine treasury data with bank data with third-party data sources to solve those challenges. And for me, one of the best things about my job is that it requires a lot of co-creation, so working with treasurers, working with our clients to solve those challenges.
We're going to be talking about co-creation quite a lot through this podcast, I think. But to start with a little bit of background, I want to hear about the external forces that are shaping transaction banking right now. Llewellyn, how is the macro environment showing up in treasurers' data and decision-making?
We're not short on macroeconomic forces. First, you've got regulation. Regulation is definitely diverging rather than converging. That's increasing complexity in treasury operations and treasury processes. Then secondly, you have a lot of geopolitical activity, and that is increasing uncertainty, increasing risk. That is increasing the friction in all cross-border activity right now and increasing the uncertainty and the risks around supply chains. And then thirdly, you have AI and technology. There's so much to talk about there. It is accelerating so quickly. There is a lot of transformation required from businesses and at the same time increasing the risk of fraud and cybersecurity that are becoming such critical challenges for businesses. So behind all of this is this massive technology transformation drive that all businesses and treasuries are involved with, migrating to the cloud, transforming their enterprise resource planning systems, migrating, for instance, if they're using SAP to SAP S/4HANA. And one of the key challenges behind that is all of these systems are moving rapidly, but the data and integration layers often lag. And that means that basically the decision cycles, the speed of decisioning is increasing really rapidly, but the foundational data is not. And you pull all of that together and you've basically got a less predictable, higher risk environment, the need for treasurers to make decisions really, really quickly. And so their fundamental ask is they don't just need to make decisions and understand businesses, they need to do it at the speed that the environment dictates and with data that they can trust.
Thanks, Roland. It's a pretty interesting background, especially to hear about the data itself not increasing in conjunction with the risks. James, can we talk a bit more about the threats to supply chains? How does all of this uncertainty translate into the physical supply chain and trade?
Sure, thanks. And following on from the themes Lou has just mentioned, global business practice and government policies together with increased volatility are certainly reshaping trade and supply chains. Meanwhile, we are seeing regulators around the world testing the banking sector's readiness to handle these geopolitical shocks and how these shocks will impact the economy and bank operations. That combination we see is increasing both client demand and a need for prudent risk management. What we're focusing on and what we're seeing a lot more of is working capital finance as corporates manage less predictable cycles. We're seeing a shift from the more traditional approach of just-in-time supply chain management to just-in-case, where companies and customers are recognizing that supply chains are being disrupted. There may be shortages of certain goods and other products. So just in case makes sense to make sure they've got inventory on water or in storage. On the risk mitigation and continuity side of things, we're helping clients manage local and international trade. And that might require documentary trade or guarantees. It might require more structured solutions and structured services that we provide to support that risk mitigation. They may be diversifying their supply chain to make sure they have surety of supply going forward. We're also seeing a real focus on digitalized trade journeys, improving the visibility and operational efficiency while reducing processing times. Digitalizing really aligns very closely with Lloyd's core elements of our corporate and institutional transaction banking growth agenda. We're driving real progress in trade digitalization, investing in digital trade processes that streamline documentation, shorten cycles, and boost working capital efficiency. That includes scaling digital trade and open account alongside with traditional instruments, supporting exporters and importers, including integrating these financial services in their own treasury systems and improving that connectivity. Additionally, Lloyd's recently committed £2 billion of dedicated trade finance to small, medium enterprises and mid-corps in the UK, delivered in partnership with UK Export Finance as part of the government's £11 billion exporter initiative announced earlier this year. That all underlines our commitment to trade and underlines our commitment to digitalising trade and making things more seamless and smooth to help customers as they deal with these uncertainties.
Thanks, James. And Nazma, based on this, where does all of this land most immediately in the financial supply chain?
Physical and financial supply chains are very tightly coupled, of course. Financial supply chain side, where it lands most immediately, is in the liquidity conversation. The rate cycle of the last few years means clients are actively managing where cash sits, for how long, and at what yield. Treasury teams have always known that idle cash has a cost. That's not a new concept, but the technology to act on it at scale, the real-time visibility, the automated sweeping and pooling solutions exist now in a way that simply didn't in previous rate cycles. At the same time, Llewellyn talked about geopolitical fragmentation. That and sanctions have added a layer of operational complexity that wasn't there a few years ago. Decisions about which payment corridors to use, which correspondent relationships carry risk, where sanction exposures sit. These are now routine parts of treasury management for any corporate operating internationally. The scale of cross-border activity flowing through UK payment infrastructure just gives you a sense for why it matters. Bank of England reports that cross-border transactions account for in between 0.5% and 2/3 of CHAP's payments by volume. International isn't a special case. It's really the default. And what keeping liquidity mobile actually means in practice is breadth. Breadth of currency coverage, breadth of payment execution options that can balance speed against cost, cut-off times that align with how businesses actually operate, underpinning all of it, end-to-end visibility so that treasurers can see what's moving, where it is, and what's coming. So that combination, mobile, visible, and predictable, is what clients are prioritizing. The banks that can deliver it consistently at scale will be the ones that retain the relationships.
So based on all of this, what would you say is the role of Lloyds in this landscape, and how have asks from clients changed from even a few years ago? Lasma, why don't we start with you?
Trusted and embedded. That's how I think about Lloyd's role. And I'd argue those two qualities are exactly what large corporates need most from their transaction bank right now. In this environment, clients aren't just looking for speed and innovation. They're looking for stability, predictability, and a long-term partner that will be there when conditions get difficult. And that shapes everything about how we build and operate. At Lloyds, innovation happens within a framework of strong controls, operational resilience, and regulatory alignment. For large corporates, payment certainty and liquidity reliability matter as much as product sophistication. They're non-negotiable. Trust alone isn't enough, which is where the embedded piece comes in. The way we create value isn't by sitting alongside clients' treasury operations. It's by being increasingly integrated into it. That means payments and effects capabilities connected directly into the day-to-day workflows, reducing the need for manual intervention and really giving treasurers confidence and control rather than additional complexity to manage. The honest context, though, is that the gap between where treasury technology is heading and where clients actually are today is still significant. PwC Global Treasury Survey shows that over a third of treasury teams are still operating manual processes for core functions. So it's not unusual for businesses to run cash flow forecasting on an Excel spreadsheet, and indeed, some still manually reconcile end-of-day positions across hundreds of physical accounts, which is precisely why technology innovation has to happen alongside the evolution of systems, processes, and risk controls. Lloyd's role as a long-term partner is to help bridge that transition and not just point at the destination.
That's a really interesting observation on bridging the transition. It's a nice way to think about it. James, how about you?
I really echo Lasma's comments there as well. Some of the things that don't change, that are universal at Lloyds, we see that customers first and foremost want reliable, competent and consistent support delivered promptly where and how they need it. It's really taking the complex and delivering it in simpler ways in design and delivery to meet customers' needs. We continue to see that information is currency, and that's demonstrated through insights and experience Lloyds has as a leading UK bank with international and global perspective and reach. Some of the things we see that are changing and evolving, optionality is paramount in trade, and the ability to provide a range of products and services seamlessly as conditions change is important. Those services and products embedded in the wider treasury and supply chain workflows is essential. That's what customers are seeking, and that's what we're developing and progressing and delivering. We're really putting innovation at the front of what we're doing, and it's very much in the DNA of the transaction banking products team at Lloyds. And part of that, we have a toolkit of working capital products and services to support businesses through both businesses as usual and uncertain times. And these products and services include various structures: documentary trade, receivables purchase, supply chain finance, inventory finance, but also enhancing that with channel and delivery and looking at other options that we can provide customers. And there are a number of innovations we are progressing currently, including distributor finance, which is coming soon from Lloyds.
Oh, good to know. We'll keep our eyes peeled. Llewellyn, how about you? Lasma mentioned that clients are asking for more embedded services across the spectrum of transaction banking products. Could you elaborate a little bit on that?
Yeah, absolutely. Both Lasma and James mentioned embedded services, real-time decisioning, optionality. All of that is obviously underpinned by data and insights, increasingly by insight-led journeys and objectives. And ultimately, data only creates value where it's delivered to the right person at the right point of time and in the right workflow tool. And without that, even really rich insights quickly just become noise. So what treasurers are asking for, what they're looking for, is becoming far more specific to the role, specific to the workflow, specific to the sector and the challenges that each industry and sector has. So I suppose if we translate that into something a bit more tangible, for smaller, slightly less technologically mature companies and treasuries, what they're looking for is for banks to still do a lot of the heavy lifting. So they're using banker platforms for a lot of treasury management services. So their cash flow forecasting, cash visibility, automated FX journeys, working capital monitoring. And that is about being able to ingest data from companies' enterprise resource planning system or accounting system, simplify decision-making and automate things. If we go to the more mature end of the spectrum, much larger, sophisticated companies naturally consolidate their technology. Their processes live within their ERP or their treasury management system. And so what they're looking for from banks is really just about enriched data, connectivity and enriched data. But even in that environment, there's still a lot of value in the intellectual property that sits on top of all of these processes. So predefined use cases, decision logic that helps improve business and treasury processes. And I think that's even true in the current environment with AI, where there's a lot of value in this intellectual property. So again, tangible examples there. Working capital analytics is a pretty mature capability between banks and consultancies. And that is really an example of where we can combine the ERP data with proprietary bank data, third-party data to highlight structural cash flow challenges, opportunities for working capital process optimization and improvement. And even broader than that, that then goes out to supply chain analytics. And most companies see a lot of benefit from being able to identify early stresses and indicators that might highlight challenges in the supply chain or just help improve the implementation of finance through the supply chain. And this is an area where I think Lloyds really excels because of the breadth of our business relationships across the UK. We understand the UK economy, we understand UK supply chain. So that means when it comes to applying this analytics, building things like supply chain propensity models, any sort of insight that helps lead financing decisions, that's where we have the data to enable those use cases.
Thank you, Llewellyn. James, there's a lot of conversation around artificial intelligence at the moment, and especially given the stat that Lasma mentioned, over a third of processes for core functions remain manual. Does AI stand to change any of this?
We're certainly seeing AI and AI applications impacting every part of our daily life, and that includes business and that includes trade. While some processes lend themselves well to automating, others are more difficult to automate. And in fact, there's a mix of automation and manual that we're all grappling with and juggling with at the moment. AI is helping banks look at and provide the trade services that they deliver to their customers. In that, AI is helping, back to Lou's comment about data, getting it in the right format, in the right place, analysing it and delivering it to the right people in the right channel at the right time. At the heart of Lloyds and our transaction banking product growth agenda, we're really progressing and driving digitalisation as part of that. And that includes digitalisation of trade. And there are a number of use cases that we're seeing and driving to improve processing times, be that automating document checking to perhaps text negotiation or generally data collation, analysis and reporting. We're an industry leader on electronic trade documents, cutting transaction times for our customers from weeks to days and in some cases hours by completely removing the need to move paper around the world. That helps release trapped working capital, it reduces costs, and it enables colleagues and clients to handle documents remotely. It also frees colleagues and clients to reallocate that time to other requirements and other processes that need judgment and need decision-making and need the use of analog experience and discussion with clients, and taking all of that analytics away and having a think about how you could harness that. We are further integrating in our clients' trade systems to help streamline internal processing time, often where manual and fragmented workflows persist. And we see further development and evolution of that as a natural next step, and it's very much a focus of what we're doing at Lloyds. We are completing a proof of value using agents to automate key manual handling of tasks end to end, from monitoring our digital trade inbox to taking and transferring possession of documents, creating draft documents for signature, and making basic routing decisions based on the content presented. Early indications show these tasks, which currently take 15 to 30 minutes of colleague time, can be completed in seconds. Also improving the reporting, it's improving the efficiency, and it's reducing operational intensity for both Lloyds and our customers. As digital trade volumes scale, this becomes a meaningful differentiator in both processing time and operational resilience.
Hey, enjoying the episode? Tap follow for more. Done? Let's get back to it.
Thanks, James. And Llewellyn, on that note, when you look at new products and client insight solutions, how are you applying AI more broadly?
I suppose to James's point about the data foundations required for effective AI, AI is only as effective as the quality, the reliability, and the connectivity of the underlying data. And that's an ongoing challenge and process for the majority of companies, organizations, treasurers right now. I mean, we've been talking about big data for over a decade, but the reality is there is only a small proportion of companies that are really in a position to scale more advanced AI use cases reliably. So that data quality, ownership, lineage, and the control frameworks, that matters enormously, because in that environment, if you don't have the right foundations, particularly in a treasury environment, then just moving faster increases risk. So I think where we're seeing the most tangible, immediate progress today, again, James talked a bit about that, is around the areas where treasurers were already focusing on automation through robotic process automation. So AI is improving those processes, making them more accurate, faster, and particularly with agentic AI, automating more of the end-to-end process in things like reconciliation, exception handling, document processing, and internal routing of documents. Alongside this, a huge amount of opportunity on the insight side, using AI to interrogate large amounts of data, analyze it where we couldn't do that before. That is really, really good for identifying patterns, structural issues, early warning signals that are inputs to cash flow or working capital models, particularly suited to scenario analysis and broad exploration rather than very specific singular forecasts. That's kind of the counterpoint is maybe to this point is in when we think about cash flow forecasting, treasurers are always cautious about anything that's black box automation. And that's particularly the case around cash flow forecasting because it's so fundamental to so many treasury decisions. In that context, AI really can enrich, it can stress test forecasts, but the reality is that cash flow forecasting in most organizations still remains a judgment-heavy, human-led process because ultimately the treasurer is accountable for that number. And I think that links back to the principle that we were talking about early. Like all data, AI only creates value when it affects the right person at the right time in the right tool. Otherwise, it also just becomes noise. And I don't want to detract at all from the fact that there is fantastic innovation and exploration going on around self-driving or agentic-led treasury models. That's really exciting. That's the frontier of where treasury automation is going. But I think for the majority of clients, the value is going to sit in more clearly defined, well-governed use cases supported by really strong data foundations embedded into existing control environments. So that balance between the innovation and the risk management within treasury is still really important.
Thanks, Dan. I think that's a really important point to keep in mind. And it ties in with what James was talking about in terms of a key benefit of AI and of all this technology is just freeing up human time to do these more decision-led processes like cash flow forecasting. Another area of rapid innovation and excitement is tokenization. Lasma, are you seeing any traction here?
Tokenization is progressing in a deliberate, regulated way, and we see it as an extension of existing transaction banking offering. The architecture shift is undoubtedly very significant. Today, the payment instruction and settlement are separate events. The message travels one way and the money follows later. Tokenization collapses that separation. The sending and the settling happens simultaneously, which means there is no float sitting idle in between. And crucially, you can build conditions and logic directly in the movement of value itself. So it's not a faster version of the old model. It is a genuinely different operating model. At Lloyds, we have already moved from theory to practice. Lloyds completed the UK's first gilt purchase using tokenized deposits on a public blockchain, demonstrating that traditional bank money can move onto digital infrastructure while retaining the protection, the controls, and indeed the familiarity that clients expect from deposits. And that matters because client trust in the underlying instrument cannot be a casualty of innovation. We believe that over time, both traditional and tokenized forms will coexist across multiple networks and rails. And what clients will need and banks will need to provide is the ability to move value across all of them without friction. So the interoperability question is as important as the technology itself. Our focus at Lloyds is on being ready as regulation and market infrastructure mature, so that when our clients are ready to adopt these models, we can support them safely and at scale. The filter throughout is always the same. Does this make the client's treasury simpler? If the answer is no, it doesn't make the roadmap.
Thanks. James, can you explain this from the trade angle?
As Lasmo outlined, the market is exploring how to apply tokenization, and that includes in the trade cycle. At Lloyds, there has been significant discussion on the suitability of using tokenization for trade solutions. That dialogue continues to evolve, with our initial focus on liquidity and distribution, on discipline and regulation. Banking at its core includes intermediation. We have seen through development in the fintech space, particularly intermediation occurring outside of what we would have traditionally called the core banking network and banking system. We're having a look at and we're assessing the regulations and the procedures. We're assessing what third-party vendors are doing. We're assessing what customers are seeking. In that, we're looking at the market architecture for the essential components, the participants in the system, the controls needed to ensure effective use of tokenization in trade value chains. And that's a real key focus for us. We are exploring how, what, and where of tokenization for trade and how we can be part of that innovation and that drive as we continue to grow our trade business and as we continue to look at what our customers are wanting and seeking. But it's very, very much from a disciplined approach to make sure it makes sense. And is it efficiency? Does it improve the trade cycle? Does it improve finance in the sector and for our customers?
A lot of the banks that I'm speaking to are basically talking about how tokenization is a buzzword and is probably part of the future, but is not at all something that clients are asking for. So how do you feel like you balance maybe what you see coming up in the transaction banking industry with what clients are asking for right now? Where do you focus on investing? Where do you focus your time?
I'd answer that first. If you're okay, in this room, we're looking at some of the posters that TFG have used in the past. There's one dated October 2022, and it says time's ticking for tech. In 2022, AI became more broad spectrum. And from there, it has been exponential. I would suggest that tokenization, we've seen an acceleration of the adoption of technology and of solutions. I suspect we will see the same in tokenization. It's not only a market pull strategy, it's an industry push as well, and it needs to be. With regulations diverging globally, we are seeing different treatment and capital models depending on the underlying assets. That requires different solutions. And I think it behooves us to keep tokenization in our view and perspective to understanding it and understanding where it's going, potentially to help evolve the market maturity around it, but to do it in a very deliberate way.
I think it's important that we invest in the capabilities and we test and build, but continuously check back to the client. What is the use case? What does it do to the treasurer's day-to-day running of their operations? And I think we might not know yet when those kind of pivotal use cases will come about and when the adoption will really snowball. But I think it's important that we do the groundwork of building, investing, learning, developing infrastructure that is scalable, safe, resilient, and just keep coming back to, okay, is this the solution that makes a difference to the client and the treasurer?
Great. We've covered quite a lot of ground. I want to tie it together with a bit of a rapid fire last questions. What are some ways to increase co-creation between banks and their clients? Llewellyn, why don't we start with you?
So when it comes to co-creation, there is a lot of really great ambition, but we're all time poor. And more so in this technology environment that we're in at the moment, we are focus and attention poor. So with treasurers juggling so many different objectives, competing initiatives, really co-creation only works when treasurers really choose a concrete objective, they bring the right partners to the table, and they commit to jointly delivering something.
Thanks, Llewellyn. Lasma, how about you?
We've talked about data and how important data is in unlocking a lot of the use cases and kind of the benefits of technology. So in my view, the most immediate co-creation opportunity sitting in front of us right now is actually ISO 20022. The migration is done at the infrastructure level. Most corporates are nowhere near extracting the value from the richer payment data that the standards make possible. And so I think the banks that will engage at that level, helping clients use better data to improve reconciliation and the forecasting and the working capital visibility, will build relationships that go well beyond transactional. I think that's co-creation with a commercial outcome attached. And I think those are the ones that tend to stick.
Thank you. And James, over to you for some closing words.
Lloyds is a relationship bank. Clients are at the forefront of what we do. Relationships should be enhancing to all parties. So we look at the priorities. We have a common interest with our clients and combine our insights, experience, and capability to make a meaningful difference. In that, we're identifying key areas to help improve clients' trade capability, to simplify and reduce operational intensity. And part of that focus is how we can digitalize. We're finding some really positive use cases and examples, working closely with partners and working closely with third-party vendors to unlock that untapped potential.
Thank you, James, and thank you three so much for joining me today. We've talked about transaction banking innovation, I think, as much as is possible, and I really appreciate you taking the time.
Thank you.
Thank you.
Thanks very much.